Good morning, everyone. Welcome to this rundown for global stocks and the Australian market for the 7th of February. For several months now, I've been pointing at the warning signs that have been becoming evident, particularly in America, but elsewhere around the world. But I've also been saying that, until we got confirmation that the markets were breaking down, that really your fundamental bias should be to the upside, because long term, markets do tend to work their way higher. So I was keeping very much an open mind, but I think it's pretty safe to draw the conclusion now that a real market breakdown has started, and that was really confirmed on Friday night, and it was a pretty nasty week to start February with. So a lot to cover in this video, a lot of really important things. If you ever take notice of one of these weekend videos, then please take notice of these, because I think we now have confirmation that the game has changed. So again, let me just give you some vital backdrop before we get in and look at the actual charts themselves. The market, in my mind, has now made a decision that it's heading down, and Friday night in the US really confirmed that downtrend. It wasn't that it was so much a big plunge. We've certainly seen moves in the S&P index of that dimension on many occasions previously, but it's the nature of the internals of what's going on in the market. As members know, I look through hundreds and hundreds of individual stock charts in America as well as in Australia, and it's when you look under the hood of the index that you really see what's going on, and I can tell you it's very ugly indeed. And that's not just Friday night. There's been some incredibly strong downtrends in a high percentage of American stocks now for probably 6 months. And it's not just the energy and the materials, the commodity stocks. It's across the board. So the market. So I'm going to go through a number of the signs that I think now confirm that the market has now gone into a more extended, protracted decline. The market is now starting to beat up the stocks that were the real darlings of 2015, the stocks that had all the momentum. And because they were fairly large cap stocks, they were also ones that were helping to hold the S&P index together. And this is the way that bear markets unfold. The smaller stocks get beaten up first and go into long-term downtrends, and it's only the big stocks that finally roll over at the finish. And when that happens, you know that you're into the start of a bear market. LinkedIn, we'll have a look at a few of these charts. LinkedIn was down 44% just on Friday night alone. I mean, it's lost nearly half its value in one session. Now, they came out with their quarterly results, and the quarterly results were actually quite good. They showed excellent growth in revenue and excellent growth in profit, but their outlook absolutely stunned the market. They were talking about revenues falling and profits falling, and the stock got absolutely murdered, down 44% on the night. Netflix was down 11% on the week. Again, one of you might have heard of the FANG stocks: Facebook, Amazon, Google and Netflix. It's one of the four main stocks that have been contributing to the market holding up. Netflix lost 11% on the week. Amazon lost 15% on the week, and a huge earnings miss. They missed their earnings target by nearly 33%. So massive moves. Now, the US earnings season is, of course, well underway, and what we're now seeing is that profits are declining compared to the same quarter a year ago in 7 of the 10 US sectors. So there's only 3 sectors that profits are rising, and that's utilities, consumer staples, and healthcare. Utilities and consumer staples sector are going okay on the stock market, but the healthcare sector, despite good earnings increase, is still getting beaten up, and the healthcare sector is down 33% from the middle of last year. Now, the US financial sector, if we just look at the 5 weeks since the start of this calendar year, the US financial sector is the worst. It's down 12%. the worst in the S&P, and the volatility is the highest that we've seen since the GFC. Now, that's really telling, because when banks are getting smacked around, you know that there are a lot of larger underlying problems in the economy. There are some real concerns out there, and I think people are still largely unclear on what those problems might be, but I can tell you that they're a lot bigger than just some defaulting oil loans. I think there's something much, much bigger going on here, and it's probably tied to derivatives. And, the smart inside money understands the potential risk for the banks, and that's very, very bad news for the stock market as a whole. And look, I'd hate to be doom and gloom on this, because basically as you know, if you've been watching these videos for any time, you know that my fundamental default position is to be positive, to be optimistic, to be glass half full. So it really pains me to put out a video with this tone, but I've got to tell you the way that it is and what I'm seeing, and it's now pretty much undeniable. And when I get to the end, you'll see that this is actually good news, as long as you understand what's going on, you're prepared to accept what's going on, and you also make some changes. Now, also too, the economically sensitive stocks are breaking down, which is a really bad sign for consumer confidence. The internet stocks got absolutely murdered on Friday night. The auto sector's down, and most tellingly, the consumer discretionary sector is down. So all pretty bad signs. The next one is that the NASDAQ is falling apart quickly. Now, the NASDAQ will always tend to lead the stock market in both directions. It'll lead it on the way up, and it'll lead it on the way down. And the NASDAQ has not only rolled over, it's the speed with which it's done it. And again, we'll look at these charts in just a minute. So that's a really bad sign. So to sum up, the S&P was down a pretty large 60 points on the week, but not a disaster. But I think there's a lot more to come. The price, momentum, and money flow indicators are all trending sharply lower on the S&P. The triggers that we saw for the counter trend rally that occurred over the last couple of weeks from the 20th of January, that was a bit of a bounce in the oil price, and then the Bank of Japan making that decision to go to negative interest rates. They were both short-term triggers for the market. They were positive for stocks, and that's typical of a bear market, when the impact of those triggers disappears within a few days. In a more bullish market, traders seize on those triggers, and the market follows through significantly to the upside. In bear markets, that doesn't happen. It's a bit of a quick sugar hit, and then bang, the markets head back down again, and that's what's happened this time. So last week I pointed out there was key resistance on the S&P at 1945, and really the market was still sitting in a mid-range, even up to Thursday night. I could have accepted that the market could have gone either way on Friday night, and it could have pushed up higher to 2000. So this is very recent. Friday night has really changed quite a bit in my mind. So to sum up, the S&P index hasn't broken down yet, but the NASDAQ has, and the S&P will follow it. So I think that's pretty much an open and shut case from my perspective. So let's have a look at some of the charts. We'll start with the S&P on the monthly chart. This is the one that I've been showing now for a year. I've left this little notation over here. It's been there for 6 months or more, to watch for a close below the 12-month moving average on this is a monthly chart. So what you're looking at here is back to 1998. So this is a very long-term chart. Here's the peak in 2000, the peak in 2008, and this is where we are now. And you can see that quite clearly the character of the market has changed. We need to close to confirm that the S&P is now going into a bear market. We need a close below 1820. That hasn't happened yet, but you can see the RSI, which shows the momentum of the market, is now pointing down quite strongly. It's now down below 50. So that's indicating a downtrend is strongly gathering momentum. The little bottom box shows the money flow index, and you can see very, very clearly that money is now flowing out of the American stock market and has been basically since around July. Even though the index went higher, money was actually flowing out of the market during that time. So there has been some divergence between price and money flow. And again, that's another indicator as well. Now let's take a look at the NASDAQ. Oh, before I go there, I'll just look at the S&P on a daily chart. So here's our rebound. We had potential resistance levels at 1915, 1945, 1977, and then possibly 2000 if it could have got that high. You'll notice that the index rebounded to 1915, paused there for 4 or 5 days, broke through with one big surge, which was the previous Friday night, and that was on the Bank of Japan decision. Monday, we followed through, and as you can see, we peaked out exactly at the 50% retracement level. So 50% retracement from the low here to the high, and then we've turned back down again. So pretty definite. Let's look at the NASDAQ. So this is a fairly big picture view. You can see that clearly the NASDAQ has rolled over, and if we zero in a bit further, you can see we had a bit of a panic sell-off and reversal in August, but I'm kind of really discounting this low here because the market turned around and finished substantially higher, and I think there was also a few system glitches in there as well. But we've gone up, we've formed basically a triple top, and we've rolled over, and you can see how badly the NASDAQ has broken down. A rapid fall, a very weak bounce. If we put a retracement scale on this, you can see that we made it to the 38.2% level, and we've turned back down again. So a comment that I'll make at the end of this video is how the technical levels are being respected, the resistance and support levels, trend lines of all these technical levels that computer programs are basically feeding off are really guiding the market. And you can see how badly the NASDAQ fell apart on Friday night. Let's just take a quick look at the Russell 2000. So this is the Russell on a weekly basis, and you can see clearly it's taken out these lows here from October 2014. Did that quite some time ago. Did that in the second week of January. So the Russell absolutely breaking down as well, which is what you'd expect. Now I've got some targets on the Russell, probably down here around 867. We're currently at 985, so that's probably another 12 to 15% before we would find support on the Russell. But let's look at some of these individual stocks that I spoke about. Let's look at Tesla. So Tesla, which is I think it's a stock that's just ridiculously overpriced and could end up being a company that doesn't make it. But you can see. And to cut out a bit of the noise, I've just shown this as a line chart, but you can see quite clearly this was a real market favorite, clearly taken out a very, very important support level. When you've had a long-term uptrend, which you can see by the red moving average line, and then the price starts to break down from it, the moving average goes flat, and then we start to take out these initial deep retracement lows, and of course that's happened just in the last couple of days. So Tesla looks really, really sick, and that could fall quite a long way. This is Amazon. Amazon has been one of the stocks that's really held the market up. You can see it's just been on a massive run from 2009, it was trading at $60 and it got to $680. It's gone up 10 times since the GFC. And we got this real breakaway spurt over the last few months. And now just look at how fast that's fallen apart. It's not the fact that it's fallen from 680 down to 510. It's how fast it's done it is the real telltale sign. People have just absolutely deserted the stock. So again, same thing. We had a bit of an initial sell-off, which occurred in early to mid-January. We had a little bit of a blip up that I think occurred when Facebook came out with their results, but that was pretty short-lived, and it's broken down very, very badly and very severely on Friday night. Let's look at Netflix. It's the same story. These lows have now been taken out. So no question, these stocks are all in individual bear markets. And these were the leaders. These were the stocks that were holding the S&P 500 index up. Now, the only reason the S&P hasn't quite broken down yet to the same extent that the NASDAQ has and others is because of stocks like Microsoft and Facebook that came out with good results. So there are a handful of stocks that are still sort of semi-holding the index together. But I can tell you, once you get into the start of a bear market, eventually everything lets go to the downside, whether it's good value or not, because people just panic and everything gets sold. And this is LinkedIn. Look at this. We were trading at $192 on Thursday night, and we ended up down closing at 107. So it's fallen from nearly 200 to nearly 100 just on Friday night. An extraordinary fall. So let's move on. The Aussie dollar finished, it's been up and down all over the place, finished just under 71 cents on Friday. It's been very volatile, and that's really because there's been a lot of volatility throughout all currencies, particularly the US dollar and the yen. The Australian dollar is still heavily tied to commodity prices, which is what you'd expect. We'll take a look at that in just a minute. The ASX 200 was down by 29 for the week, but it will almost certainly decline, and possibly quite significantly on Monday. 46.50 is the next target. I've had that there for several weeks, and I wouldn't be surprised if ultimately we end up lower than that. So let's just take a look at the Aussie. So the Australian index. So if you look at the red 150-day moving average line, there is absolutely no argument. We're in a downtrend, and the price remains below that moving average. So, there's no debate about whether the Australian market's in a downtrend or not. I know some people are trying to, they're looking at this pattern here from August saying, well, the Australian market is not in a downtrend. It's just going sideways. Well, that's within a narrower time frame. The definition of a downtrend is the 150-day moving average is heading down. The price can't get above it, and you will see the Australian index break down further, which means that there's going to be selling in the banks. And here's our initial target. But look, I wouldn't be surprised if this bear market really gets legs in America if we couldn't end up down somewhere around the 4,000 point mark in the Australian market. So there's a lot of stocks that I think are heading quite a bit lower. This is the US dollar index. You can see there was a couple of days of sharp selling, and that's really about people anticipating that the Fed will now not be able to raise interest rates. So that's what that's all about. I don't expect there's going to be much net movement, because I agree. I think the Fed is probably now going to have a great difficulty raising rates 4 times during 2016. In fact, I think that's just absolutely dead. They might be able to squeak out a rate rise or 2, but that'd be the most, and things would need to improve. But so really that should really send the US dollar down. However, you've got Europe on negative interest rates, you've got Japan on negative interest rates, you've got China very likely to do a devaluation, You've got negative interest rates in several Scandinavian countries. So I don't think the US dollar is going to ease too much from here. And finally, this is the Australian dollar. We had a bit of a surge, and that was really about the price of oil jumping. But I would expect that oil's going back down again, and therefore we should see the Australian dollar head lower. And I think a target somewhere in the low 60s is probably where we're going. Turning to commodities, gold had a great week, higher by $56, and it was the week's strongest sector in the US. The GDX index was up by 20% on the week, so no question that gold is getting some momentum. And it's not surprising because we're now starting to see some financial stress, and that's where money flows into gold assets in times of stress. And I said about 4 months ago that given virtually non-existent inflation, that the only hope for gold going back into a bull market would be a financial calamity of some sort. Now, I'm not saying we're going to get a financial calamity, but certainly people are positioning themselves just in case, and that's why finally we're seeing some money flow into gold. So specifically, the lower dollar, the lower bond yields, and the lower stock market is all making people extremely nervous, and hence the move into gold. But there's still no breakout, but it's looking a lot better than it was. So let's take a look at gold. So this is gold on a daily basis, and you can see the last four of the last 5 sessions for gold were extremely positive. Larger range candles, all closing virtually right on their highs. So that's very, very positive. But if you pull back, you've got to say it hasn't broken out yet. It's still in a basing pattern. It still hasn't broken this long-term or medium to long-term trend line. And we've seen these blips before. One here, another one here, another one here. So until this breaks out, which is really above 1200, it hasn't done anything, it hasn't proven anything yet. And in the short term, you can see the gold price is now overbought. So we may well see a pullback. So don't suddenly decide that you should need to pile into gold stocks so you don't miss out, because the odds now are quite strong that we might see a short-term pullback. This is a weekly chart on gold to give you a sharper picture. Yes, it's been a big move. It's been one of the better moves that we've seen. You've really got to go back to this time last year. So the first 2 weeks of January last year when we saw moves in gold of this dimension. Interesting that it's the same time of year. Let's look at the GDX index. So pretty good night. Now it was really only the last 3 sessions. Other than that, gold stocks, as opposed to the gold price, was still down here. So gold stocks were still underperforming. So it's only been 3 sessions that gold stocks have really kicked in. But you can see the volume. The volume has doubled. So certainly some big interest flowing into gold. Copper a little bit higher to $2.10, but again it's just moving with the US dollar. Crude oil got up to 34, but eased back to 31. And if you look fundamentally, I think the price of oil almost certainly has to go back down again. This bounce that we've just seen was really just a bit of short covering. The fall in the US dollar triggered a rise in the price of oil, and then that got added to by short covering. So the people that have been short oil had a lot of profit on the table. They were buying back their positions, and so that just added a bit of fuel to the fire. But if you look at the fundamentals, the supply and demand balance is still completely out of whack for oil. We've got Iran now making sales into Europe. They're already above 300,000 barrels a day. Back before the sanctions, they were over a million barrels a day. So they've still got a long way to go yet. So I can't see anything changing in the crude oil market for some time. That's the spot copper chart. And just to wrap it up, Look, I know there's a bit of a negative tone to this video, but the one thing I really want you to understand is that the profit opportunities in bear markets are even better than in a bull market. Now, they're harder to get your hands around, but prices move faster and further than they do in a bull market. So if you accept that premise, then it's a matter of knowing how to tap into those profit opportunities, because I can assure you that the opportunities are terrific. But you must have a bear market strategy, and that strategy is completely different to the sort of strategy that you would have in any other kind of market, be it sideways or a bull market. It looks nothing like anything that you've ever done before unless you've been through a bear market. The sentiment has changed. That means the emotions that are driving the market are now completely different. The market is being driven by fear and greed, by fear and panic, not greed, not fear of missing out, and they're completely different emotions, and they play out in very different ways. So the rules have now changed substantially, and if you operate in the standard default mode of trying to, just trying to buy the dips, then I think there's an incredibly high probability that you're going to lose money over the next 6 to 12 months. There's no other way to put it. So you've either got to get out of the market or you've got to change your approach. Now, my overwhelming advice would be change your approach, because the profit opportunities are incredibly attractive. I wrote this last week. You've got to be guided by the chart patterns. It's very, very clear at the moment that markets around the world are being driven by technical factors, far, far more than fundamentals. Fundamentals and valuations they're not irrelevant, but they're just kind of being ignored at the moment. It's all about people projecting forward with a negative attitude. Therefore, they're seeing the worst in every possible situation, and prices are just getting whacked. But the technicals, and you've got to remember that a large part of trading these days, it's been estimated that about 70% of turnover in the American stock market is controlled by computer algorithms. Now, those computer algorithms are responding to pre-programmed instructions, and those instructions are based on technical support and resistance levels and all the different technical indicators that they use. So of course we're seeing markets moving according to those technical indicators. And frankly, I'm finding that markets at the moment are incredibly predictable. Now, they're also volatile, which makes them tricky, but they're really quite predictable. So, hence I'm really excited by the opportunities, and I hope that you are too. There's my contact details. If you've not been through a bear market before, or if you've not tackled a bear market successfully before, then this is a time like no other when you absolutely need support. If you want to be in the market, if you want to take the opportunity to grab what's going to be on offer, then I strongly suggest that you get some support. There's my contact details for anyone watching this video who's not a member, and I'd love to be in a position to help you. That's it for this week. It's just going to be fascinating week after week after week. Wouldn't miss it for the world, and talk to you next weekend. Cheers.